Hello and welcome to the download. I'm your host, Dave Richardson, and we are joined, as we usually are this time of month, by Canada's hardest working economist, Eric Lascelles. Eric, welcome to Jobs Friday, which we've delayed obviously because Jobs Friday was Good Friday,
hmm
so now we're doing it Easter Monday, which I guess is better. I don't know. When I was growing up in Montreal, we used to get Easter Monday off instead of Good Friday, which I always found very odd. Quebec has now changed, and now they get Good Friday off like most other places. But even here in the Azores, which is very highly religious, all the stores are open today on Easter Monday. So I guess that makes this an appropriate day to do everything.
Well, gosh, I mean, I have to say, this is the one holiday of the year where every single year someone needs to tell me if I'm getting the Friday or the Monday off. I'm incapable of remembering this fact from one year to the next. So I'm impressed the statistical workers at the BLS were out there pumping out this number. I guess it's critically important it goes on a Friday, but gosh, I guess some overtime hours being earned there. But we did get the numbers, and
Okay, but
they look
only in the
actually pretty.
U.S.
But only in the U.S.
Only
That's
in the
right. Yeah,
U.S. Yes,
often
yes.
Canada goes a little later, and so Canada's will come, I guess, a couple days from when we're recording this, and we're hoping that number, by the way, is a positive because it was a big, deep negative in the last month, and so not that the Canadian economy is great shakes, but I'd like to think it's not in the kind of free fall that one single
Yeah,
jittery month would have otherwise suggested, and I don't think that it is. But yeah, for the U.S., I mean, we did get. I mean, the headline was quite good, in fact,
yeah.
and so let's revel in the fact that the U.S. payrolls added 178,000 jobs. It almost feels like it's. I'm trying to pick the right year here. It almost feels like it's 2023 or something like that in
Yeah.
terms of we were awfully spoiled and used to those 150 to 200,000 kind of months for a very long period. Obviously, this is no longer that era. That's actually quite a good number, and in fact, normal. I was just doing the math. Over the last 6 months, the average month has been plus 89,000, and actually there have been certainly spells where it's been sort of sub 50,000, and so it's been slower in general. But of course, the twist, as we know, is that immigration slowed, and so actually that hasn't been too bad. And so even at that lower rate of growth until recently, you were still sitting on a roughly steady, reasonably decent unemployment rate. And so, how did the March numbers change it? Well, again, big strong number, and the unemployment rate did come down. It came down to 10th officially, but actually kind of beneath the weeds, I think it was like 8.18% or something. And so it was actually a bit of a bigger unemployment rate drop. The thing to know, and the reason you shouldn't be too over the moon about this, is if, first of all, there was a strike the prior month that got resolved, and so that does make some of these numbers look a little bit better. There was a healthcare strike. The other thing is, and this is very peculiar, and I was just noticing this as I was studying the numbers when they did come out, because of course I'm working hard on Good Friday, Dave,
Yes, yes. I know that.
as I should, I
No
suppose.
doubt.
And so actually, every second month of U.S. payrolls over the last 10 months has been positive. This is a positive one. Every second month, the other months have been negative. And so we've just kind of gone back and forth between quite good and not so good, and back and forth. And again, everyone's gotten scared each time you've had a negative month, and people, in fact, last month was the big negative. It was minus 133,000,
Yeah.
and everyone's gotten excited with the big positive. And probably we should be looking at a smooth version of this and be neither overly excited nor overly grim. As I mentioned, sorry, I said 89,000 per month over 6 months. That was the cumulative. Pardon me. So
Yes.
we've been running kind of more like 15,000 or so a
15,000.
month,
Yeah.
which again is, I think, if anything, a little bit underwhelming given where the immigration and population growth is. But again, not devastating. And the bottom line is this unemployment rate has sat between about 4.1, 4.2%, and 4.5% for months and months now. It is not showing a particular direction. That is a pretty decent unemployment rate by our definition. Again, it just fell actually from 4.4 to 4.3, and obviously some concerns. Then you say, well, gee, there's this war, of course, that broke out in the last month, and cost of living goes up, and other things go down, and so that may yet do damage. In fact, you would think it should slow some things down. However, interestingly, we track weekly jobless claims, and they just very stubbornly keep clicking along at a very low, sort of 200,000 type number every week. And we just got the latest, which I think is for just about the final week in in March, and so 4 weeks into the war, and it's sort of unbudged. And so I would say
Yeah.
so far we're not getting a big negative hit right into the gut of the economy in the U.S. right now.
Yeah, I mean a lot of different commentary that reading and listening to over the weekend. As I look at it, it's sort of it's just kind of there's not a lot of hiring, but also not a lot of firing. So that's a nice balance there. Unemployment rate, of course, is higher than it was. Again, if you go back a couple of years, but 4.3% unemployment in the U.S. is not a bad number. I often remind everyone, I'm of a little bit older vintage, and I go back to a time when I was at the University of Toronto studying economics. They said the lowest you'd ever see unemployment in the U.S. isn't around 5%. That
Hmm.
was the natural rate of unemployment back then, and
Yep.
again, that's clearly things have gotten better in that direction. Of course, wanted to look at how this might impact the Fed or give a signal around what's happening
Hmm.
with inflation and economic growth. And so it kind of, if you again you put into the factor, and we mentioned, if you Eric's on every Jobs Friday, which is the first Friday of every month. So we sometimes get delayed by a holiday, as we did this time. But right in around that Jobs Friday, if you want to subscribe, click to subscribe or wherever you get your podcasts, or subscribe on YouTube to watch us. But we've talked a lot on previous episodes, previous appearances by Eric, about the idea that if you don't have any population growth in Canada and the U.S. was largely being driven by immigration. You clamp down on immigration, and all of a sudden you don't have a whole lot of job growth. And again, things just kind of seem to be, I haven't heard anyone use this term, but I look at it, it's kind of is this a Goldilocks jobs market where it's not too hot, not too cool? It's just kind of ticking along, and does it say anything about economic growth? And it just kind of looks like the
Hmm.
Fed can just kind of sit back and don't worry, we're going to get into all the other stuff that's going on in the world, which can throw all of this
Right.
into a blender, so to speak. But it really looks like we seem to be in some kind of an odd equilibrium.
I think so, and maybe the reason you don't hear people use Goldilocks is people want to have their cake and eat it too, and so they'd love job creation to be super strong and unemployment low, and yet somehow magically inflation is also low, and the Fed can cut, and all the things that really don't logically fit together. But that's when people are. There's always some grumble, I suppose. But
Yes.
I agree with you. I mean, we're seeing a steady unemployment rate. We're seeing an unemployment rate that I would describe as kind of the modern day NAIRU, that concept you mentioned, which
Yeah.
is maybe 4 to 4.5 is the old 5. You're right. I mean, I think you mentioned earlier we did spend some time below that. We were in the mid threes there for a while, but I do think in retrospect that was unsustainably low. We were seeing some accelerating inflation, and it didn't prove sustainable. And so I suspect the Fed does look at this, and again in isolation. And we've all given this foreshadowing of other things we need to talk about in a moment related to wars and oil and things. But in that context, this isn't screaming for any particular urgent action from the Fed. And I didn't mention it, but wage growth was up another 0.2% month over month. Pretty modest to moderate number. Nothing really to write home about there. No sign of surging inflation, at least from that side, if that was where the concern was. And if you're feeling lazy, and I often do feel lazy and don't want to look at every single individual data point, I do like to look sometimes at Citibank runs a nice data change index, and in fact I've got that on my screen right now, and it's a modestly positive number that would suggest that the economy, the economic data, if anything, over the last few months has gotten a little bit better, not a little bit worse, but hasn't changed in a major way.
Yeah, it's really quite amazing. And again, this is a March number. We have the conflict in the Middle East begins on February 28th. The last time we had you on, it was really just the beginning of it.
Yeah.
I guess at some point you expect that the effect of this starts to creep into the economy, and perhaps employers' confidence in where things are going, and of course, again, the risk of inflation, the risk of then higher interest rates, that kind of creeps in as well. Just the cost of doing business when the price of energy is higher, and so many
Hmm.
industries are energy intensive. You would think that would creep in, but it certainly didn't in the March numbers. So Eric, when you come into a conflict like this, and particularly in an area where there's an enormous amount of energy supplied to the world, along with a
Mhm.
number of other things, but really it's oil and gas coming out of through the Strait of Hormuz. If I'm still working on my pronunciation on that one, Eric,
Sounds better than mine.
I may get it right by the end of the conflict, but you take 20% of the supply off the table, 20 to 25% of the supply, with a little bit creeping
Mhm.
out here and there.
Mhm.
Has this played out the way you would have expected, given this kind of an oil price shock?
Dave, don't forget about all the birthday parties and the helium shortage as well that's resulting. There's also some
Oh,
helium. I should say the helium is more for the electronics industry, for those who don't know, than the birthday party industry. But you're certainly right. The main focus, correctly, is on the flow of oil and natural gas liquids through the Strait of Hormuz. So is it playing out according to expectations? I mean, it is, in the sense that a pinch on the supply of oil sends the oil price higher, and we can see it showing up in some inflation numbers now. And I guess we're sort of waiting on the growth figures, but we would assume that for most countries there will be a temporary hit to growth. And so, in a very kind of loose, stylized sense, it's all of the standard channels are playing out, and we are seeing some confidence metrics fall, which could then feed into spending decisions. And so there's quite a number of channels at play. And of course, markets. I guess I should mention, markets. Of course, risk assets are down, as you would logically expect. It gets a little interesting when you start talking about the price of gold, and I would say it wasn't crystal clear going into this, which way bond yields would choose to focus on, and whether risk aversion would send yields lower, or inflation thoughts and central bank thoughts would send them higher. But broadly speaking, I would say this is fairly textbook in terms of the response. I will admit, and so again, we talked a month ago. I've said some other things on some other forums since, but I will admit, and I think the market felt similarly, that we were all sort of hopeful this might be resolved by now. And so here it is, a full month and a month and a week in, and it's still possible it gets resolved quite quickly, right? You really can't say when a ceasefire gets agreed to, and we know there are proposals and counter proposals. It's not impossible this thing wraps up sooner than people think, but equally, it is dragging on. And I was just checking some of those online betting markets are actually quite wonderful for really getting a very clear sense for what the market is thinking, and just checking those. Kind of the active debate right now is, if you're an optimist, you think this gets resolved, the war ends within 3 months of its start date, and so you're kind of talking about by the end of May. And if you're a pessimist, you think it takes longer than that. That's about where the 50-50
yeah,
odds of
yeah.
timing are. And so again, we'll see. If pushed, I remain stubbornly a slight optimist, but let's not focus on that. It really could go kind of either way. I think instead it's worth recognizing, well, this is lasting a bit longer, and so we do need to start to think a little bit about some of the second order effects, and I guess the risk of things getting a bit sticky. So, for instance, I think the consensus, whether you think it takes 5 months to resolve this, or it takes a month and a month and a week if we're super lucky and it all gets fixed tomorrow, which is less likely. It's probably a temporary shock. So we don't think this is a new permanent, and oil is $110 a barrel forever. We think it reverses, and so a lot of the damage gets to unwind. But the question is, how long does it last? And then you start to see some other consequences that are harder to reverse.
So Eric, just explaining again how this creeps out into an economy.
Hmm.
Let's stay with a shorter term conflict,
Okay.
and where you've got this energy spike. If you look at energy oil futures right now, you can look at the monthly oil futures. So those markets are telling you where it thinks the price of oil is going to be each month in the
Hmm.
future. And by the time you get to December or January, the futures are pricing oil at around $70. I haven't
Yeah.
checked just in the last few minutes, but it's around $70 a barrel. So in that case, the markets are expecting, as you suggested, a conflict that goes on a little bit more, but ultimately ends and then produces more of a shock than a sustained period of higher energy prices.
Hmm.
In that instance, does that look kind of? I think we've talked about natural disasters where you get, a storm comes into an area, destroys everything, hurts the economy in the short term, but ends up actually helping because afterwards you have all this additional building and rebuilding that happens post disaster. Is that kind of like what happens here where, in the short term people kind of clamp up a little bit because, hey,
Mhm.
I go to the corner gas station, and the price of gas is up, right? And that filters through everything, potential in the near term. If you supply shortages, prices go up in certain areas. But again, if it's short term, comes back later, I'm back to normal, and then I just kind of carry on as if it was the way it was before, or is a little more complex than that.
Yeah, I mean, I think there is a lot of that temporary natural disaster sort of parallel, and then it depends how long it lasts and whether we need to start to factor in other things. And so maybe the one difference versus a natural disaster is when we talk about the rebound after. Some of it is just, hey, I was sheltering in my house for a week and now I'm back to work. Some is I need to build a new house. Now, there's no build a new house here, broadly speaking.
Yes.
There is
Yeah.
the get back to normal. So, for instance, we're starting to see the effect of higher oil just on inflation, as you would expect, and I should say through the channel of energy prices, so the direct effect, because there's some indirect things to think about too. But the direct effect, the European inflation print did come out for March, and we did see, a pretty notable jump, and that was to be expected. And indeed, Asia and Europe are probably the most affected because the natural gas price side has been especially relevant for them, and even the oil side's a bit more consequential versus North America, which is not unaffected. And I can say that as I filled up a gas tank, triple digit price there just yesterday. But it is actually affecting North America. It's much less. Certainly in the natural gas space, also in the oil space, and even just we think about the price of oil, but actually just the availability is limited in some places. You can say I'm willing to pay so much a gallon or liter per gas, and you can't necessarily get that in Vietnam right now. So there are some additional consequences. But so we can see it in the inflation. We look at real time inflation metrics too, and so even for the likes of the U.S., we can see prices, CPI is going to jump by a good percentage point when we get that number out. And in Europe and Asia, maybe it's a percentage point and a half when all is said and done, presuming the current oil prices prevail for a period of time. But as you say, to the extent we get a resolution a few months from now, you should expect not just prices to stop rising, but of course we should have a month where prices fall by a percentage point or maybe spread over a
Yeah.
few months, but that sort of idea. And so, actually we tend to focus these days on forecasting kind of Q4 over Q4 inflation. So technically we're actually forecasting what will the price level be October through December of this year versus last year. Still up for debate whether we need to significantly increase our forecast, because if you think the war is resolved by then, which is pretty far away, and it takes longer, I think, for oil prices to settle, but as per that forward curve that you mentioned, it's still not clear how much extra we should price in if you think this is a temporary shock. Now, I think where it could get tricky is if instead we start to get that longer scenario, and it already is, but then transportation costs, of course, have gone up, and maybe the price of an apple has to go up to reflect that, and maybe it's harder to unwind that price increase later. It's just a little bit more removed from the gas pump itself. And so I would say I don't think we're seeing too much of that. In fact, we've had a few anecdotes on the ground where, for the most part, people are eating that transportation cost for now. But I would say classically, if you start to see an oil shock that lasts for, say, 6 months or something like that, that's when you start to much more significantly see it impacting other things. And then even if it goes away in the seventh month, it's a little bit harder to put the genie back in the bottle in terms of getting prices down, particularly for other products that is sort of less directly visible. And maybe similarly, I did mention the economy, but of course, economic demand is also a bit softer when people are feeling poorer, and so that shows up too. We've seen consumer confidence hit for sure, though I would equally warn that consumer confidence is one of the least useful guides to consumer behavior. Unfortunately, it's a great
Yeah.
frustration to us all, but you would think that people would behave a bit more cautiously for a period of time. But I will say this, and Dave, I'll stop soon because I'm talking too long. But when we run our models, and the models are, I'm sure simpler than they should be, but when we run those, it would say, yes, there is a hit to economic demand around the world, and on the order, and this is if it's a permanent shock, and we're certainly hopeful it's not, but if it's a permanent shock, kind of on the order of the most adversely affected countries could lose a percentage point of economic growth or a bit more, which, isn't nothing if you're talking Japan or the Eurozone, where they're only growing at, 1.5% anyways. So there is a real
Yeah.
temporary
Yeah.
diminishment there for sure. Interestingly, if you're talking North America, and it certainly varies enormously by sector, and I will never claim the consumer is going to celebrate high oil or anything, but our our models would say actually, the implication for the U.S. economy is around neutral, around flat. It would claim for Canada, actually, the Canadian economy should run a little faster because Canada is such a powerhouse oil and energy exporter. Now, within that, you're going to see consumers not feeling so good and manufacturers not feeling so good and energy producers feeling incredible. And so, we're pretending we can all even that out and say, hey, look, it's a good thing, and it's not good for everyone. But at a bare minimum, I would say it's surprisingly nuanced. Now, those models might be a little bit, I mean, they are simplistic. They're both very complicated. I think there's 30,000 equations, Dave, so I shouldn't play up the simplistic side too much. But equally, they don't understand all of the nuance to this, and they don't know what the Strait of Hormuz is, and they don't realize this thing could be temporary, and so on. And of course, what those models aren't assuming either is, well, we have seen the stock market go down a bit, and so maybe, stock market wealth effects are now a bit less friendly to spending than they were, and, somewhat unconventionally, interest rates have gone up, and so mortgage rates are a little bit higher than they were, and so there is some damage trickling in from other channels, such that I haven't quite gone and radically revised up my Canadian growth forecast. But it's worth recognizing at a minimum there is more durability and resilience, I guess is the word, in North America than a lot of other places.
So you've raised a lot of stuff there, and let's just pick it apart. And I'm gonna pick it apart in three different areas. So the first one is the idea that this is a fairly quick conflict. Then we actually get, dare I say it, transitory inflation because it's a transitory spike in energy prices. So at that point, we came into the year with the expectation that the Fed was more likely to cut than raise rates. Not a lot, maybe one or two times, a couple of times. I guess I saw some forecasts as many as three, but now that kind of pushes that off, even in the sense of even a quick spike in energy prices that say last 3 months, 4 months, we're back down at 70, maybe even the high 60s for a barrel of oil by the time we get to the end of the year, early next year. It does kind of it does put off any reductions in interest rate, or could it happen so fast that you could still see that in the latter part of the
Yeah,
year?
no, it's a good question. I think it is right to say it puts off rate cuts. I do want to push back, and this, by the way, is very foolish on my part, since if you're talking about markets and efficient markets, you could say there's so many analysts covering one of the mega cap stocks. It's probably a pretty efficient market. It's tough to get an
Yes.
edge in that particular space. It is very similar when you're talking about, let's say, the Fed. There are tens of thousands of very smart people all analyzing it. You probably shouldn't spend too much time thinking you're sufficiently clever to say, "Aha, I predict the opposite." The opposite might happen, but not with great regularity. I would say though that so you can't really get away with cutting when there's been this inflation spike, even if it's temporary, and even if it probably goes away. You kind of need a bit of proof it goes away. You also want a little bit of proof that we didn't get second order effects, and so unfortunately that does sort of slow everything down, even if there were to be a war that ended soon. I would stubbornly, and despite that caveat I gave, push back a little bit and say, I'll tell you what economic theory says, which is you're not supposed to be raising rates into an oil shock, into a supply
Yeah.
side oil shock. I mean, it's not a function of excess demand, first of all, and so you're not trying to cool anything down, which is what rate hiking conventionally does. If you think it's temporary, well, it's temporary. You shouldn't be cooling the economy needlessly for something that should unwind at a later date. And even if, and I don't think this, but even if, I guess the worst case scenario is so much energy infrastructure gets damaged that there isn't a, rebound in production and a decline in prices later, even if somehow that's the scenario, which is not, I don't think, what's tracking right now, you know, that still means you would have high inflation for 1 year, and then the price level remains high, which of course none of us like, and this was one of the
Yes.
great frustrations coming out of the pandemic. But it's not high inflation after that first year. Actually, in theory, it's back to a normal rate of inflation, albeit a higher base, and that's not central bank's problem, believe it or not. And so they don't worry about that. And so,
Yeah.
meanwhile, the economy suffers in that scenario enduring damage. They are meant to. The models would say Energy shock, you cut rates a bit more than hike. Now, the practicalities are that's not how they're thinking, and I suspect the models are again a bit simplistic. But I guess maybe I'm thinking more about in Europe and in the UK and so on, where we had some significant extra rate hikes priced in. I'm not totally sold on that. So yeah, I think we're going to see a lot of sitting on hands in the near term. I'm still hopeful that with the resolution of a war, and certainly acknowledging that there is set to be a new Fed chair who is in theory dovish and keen to prove his mettle there, that I still think there could be some cutting in the U.S. a bit later in the year.
Yeah, I think what was interesting in terms of what the Fed officially said, which is Powell was out at his news
Mm-hmm.
conference after not raising or lowering rates at the last meeting, that they view this as a shock,
Yeah.
and that's not a time to be raising rates anyways. And then you kind of want to see if there's any further damage done by extended
Yeah.
periods of higher inflation due to higher oil prices. But so then let's flip it all the way over to the other side now, Eric,
Mm-hmm.
and we get into this where you've got those effects spill out into the broader economy. You have energy prices that remain high, maybe even go higher for longer. It looks a little bit more like the Russian invasion of Ukraine, where you started at you started at a higher base for inflation, not as high as back then, but you still had inflation that some would argue was not completely under control. Then you get this energy spike, which goes on for several months, and again, maybe we get up to 120, 130, $140 a barrel, and that's where that demand destruction comes in. And how long would this have to last, and what would it have to look like for us to have a recession out of this?
Yeah, I mean that's the question, and you do look at historical recessions, and it's not unusual for there to be an energy shock component to it. Though I should say I do think that some of that is overstated. So, for instance, did oil prices spike in 2008? They did. That wasn't really the main driver of the subsequent recession. It was a financial crisis, and the things did fit together a little bit, but we have to be a little bit careful with that. So, I'm certainly with you that if things go in the wrong direction here and oil is rising, not falling, and the war isn't resolved, the recession risk goes up. And so we've got one very simple. That's my phrase. This call, I guess. Forward-looking recession model for the U.S., which maybe isn't perfect since the greater risk would be Europe or Japan or something, but
Mm-hmm.
for the U.S. And it has said, listen, the recession risk over the next year has gone up over the last month. It factors in oil prices, credit spreads,
Yep.
stock market, I believe, jobless claims, some other things. So a mix of kind of market and macro forces, but critically oil prices. And it says the recession risk was really low going into this. It was sitting at 5-6%. Right
Wow.
now, it's saying the recession risk is around 12%. So, doubled would be one way of framing it.
Yep.
Still saying fairly low. Now, let the record show that I've always thought that's a little low. I think the risk is probably higher than that. I don't think it's 50%. It's higher than that.
Sure.
I didn't check some of the betting markets today, but when I did check late last week, they were sitting on kind of 35% type risks over the next year,
Okay.
which I might say the real risks for the U.S. a little bit lower than that. It's kind of in between those two numbers, perhaps. But notable and up 10 or 15 percentage points from before the war. And so that's probably the right way to think about it now. I don't think it's a certainty, though, that even an enduring oil shock is equal to a recession. And let me maybe mention two critical thoughts. And so one would be it is the important one. Just the intensity of orientation of the economy towards oil and energy is down. And so,
Yes.
versus the 70s, and that was kind of the two big bad ones. I'm forgetting the exact number, but the each unit of economic output needs about 62% less oil to function. And so that is to say that I guess you could say there's 62% less problems when you have an oil shock of a similar magnitude. And so it's just the service sector of the economy is so much bigger and just does not lean on energy on oil to the same extent. And so the exposure is much diminished. You need a bigger shock to achieve that kind of really bad outcome. Is I think the big point. You mentioned the war in Ukraine, and so in a bad scenario where oil goes up to 120 and sticks around for a number of months, I mean that is sort of the 2022 Ukraine war
Yeah.
scenario. Do note this though. I've seen a lot of analysis saying okay, and like it wasn't so great, and central banks were hiking rates, and inflation was so high, it was really bad. Markets were unhappy. I mean, 2022 was not a happy year. Just keep in mind, most of that was not oil prices or the war in Ukraine, right? Like the oil prices sent inflation up, a percentage point and a half. Inflation was 9% in the U.S. It was 10% in I guess the U.K. And so that was more a function of the post-pandemic rebound and supply chain constraints and all those sorts of things, which are totally separate. That was more, very much more, the driver for why central banks were raising rates. The aggressive hiking from 0 to 4, 5, 5.5%. That was what would created suddenly this very high recession risk and the market bear market. So we're only dealing with, at worst, kind of one of about three things that were happening in 2022. And so it's a useful parallel, but it's an imperfect parallel, I think.
Yeah, and that's what I really wanted to draw on is just that idea that you can go back and history can be a guide for the way things play out through different economic circumstance, but then you have to come forward to where you're actually sitting in the present and make the adjustments for that. So, for example, I'm a child of the '60s. I was born in the '60s. I grew up in the '70s. I very much remember the oil crisis in the early 1970s in Canada. I remember the car that we were driving. I think got about 5 or 6 miles to the gallon, where a typical car today, even what they'd view as a gas guzzler, is getting in the 25, 30 miles per gallon range. So this is a completely different set of circumstances. We didn't produce a whole lot of oil in North America at that time. That's obviously different. And then again, there's been moves to move away from carbon to begin with, which means we have other energy sources. And so there's all kinds of reasons why this looks a lot different from that. And then certainly in 2022, we're at the back end of a global pandemic where we locked ourselves in our houses for several months and the global economy was shut down. And then we boom reopened it after spending trillions of dollars and cutting rates down to zero, interest rates down to zero. So we're not really in the same space there. So the likelihood that that happens, and I think a couple of the things to watch that I know I'm watching anyways, Eric, is I get up and I watch the 10-year U.S. Treasury yield, which is up a little bit from the start of the conflict, but has stayed incredibly tame through this. And then again, if markets were expecting a recession or seeing a significant chance of a recession, you'd likely see more of a pullback than we've seen in stock markets around the world at this point. So again, we're not saying it's impossible for that to happen, but you would have to go well beyond this and well beyond, I think, at this point, most people's expectations of where this conflict goes.
Yeah, I think that's right. And so it's all very real and very serious, and markets are right to focus on it, but not an automatic recession, that's for sure. And again, it's kind of back to the, as long as this is a temporary shock, and again, the point is not to now engage in like military strategy and debate here, Dave. I suspect that's not where you're hoping to take this, but the ceasefires can happen for any number of motivations. Overwhelming victories are not completely out of the cards either. There's a number of ways this could go. I guess as we're recording this, I was reading a fascinating article, and we track the number of ships transiting the Strait of Hormuz every day, and actually, notably, it is up a little bit in the last couple of days. And it's a tricky business where I gather ships are paying money to Iran, and no one quite likes the ideas behind that. But I just read Pakistan's been given a quota of 20 ships to come through. They don't even have 20 ships they need, so they're looking at kind of lending that to others. And we've seen a French ship through, and apparently Iran has said that brotherly Iraq is allowed to send ships through. And so the worst of the pinch may even be starting to abate a little bit right now.
Yeah, and so again, hopefully, although we had, I guess, right around this time last year, we had Liberation Day. The day after we're taping this podcast, we have Power Plants and Bridges Day,
Mm.
apparently in Iran. If we don't get a resolution, so we'll when by the time we have this posted, we could be in a completely different scenario, and all of this discussion is moot. But hopefully that's not the case. Finally, just one last topic, Eric, because I do like to bring it back to Canada. We've talked a lot over the episodes over the last several years, the underperformance of the Canadian economy, that we just can't seem to get the economy moving at the same level as what we've seen in the US. Fortunately, for the last 18 months or so, the Canadian stock market has actually outperformed the U.S.,
Hmm.
which is in some ways a little bit of a sign to thing of maybe good things to come. But I was in Saskatchewan last week doing, and I was out with a bunch of investors, and I was from the north end down right down to the south end, and you think about what we've talked of a couple of the shortages, one being oil and gas. Of course, fertilizer and tons of potash out there in
Hmm.
Saskatchewan. A whole bunch of uranium if you want a different source of power from nuclear power. And again, if you're worried about your kids' balloons, Eric, they got a ton of helium in Saskatchewan too. I don't know if you knew that. All kinds of helium in Saskatchewan.
I don't even
So,
know where helium comes from. Is it from a rock? Is there a gas bubble? I need to look these things up. I guess probably not the latter, as I think of it.
well, it's again, there is a lot of helium in Saskatchewan in Canada, and for that matter, there's a lot of the stuff that everybody needs all around the world
Hmm.
here in Canada. Does this again, hopefully, quick conflict?
Yeah.
Is this not just a bat signal out into the sky, from Canada? Maybe it's not a bat signal; it's a big maple leaf signal out into the sky. Come to Canada. We've got what you need. And is this not perhaps, hopefully, kind of a turning point
Yeah.
for Canada and where the Canadian economy can go as people realize, like, hey, if I really need to get helium or fertilizer or oil or gas,
Hmm.
geez, there's that friendly country, a very, very happy, friendly, polite people that don't have a lot of conflicts, not a whole lot of issues there, and they got a bunch of good stuff that we could use. Is that is
Yeah.
that is that what?
I
Am I being too optimistic that this is how this might play out in the end?
I am equally hopeful. So I mean, let me do the two-handed economist shtick for a moment. So I'm cautious in the very near term, just because. Well, listen, for one, there is this war, there's uncertainty, there's a
Sure,
degree of risk
sure.
aversion. Hopefully, that gets resolved within the next few months. The USMCA isn't quite settled. We do need to get that trade deal settled, and it's not quite clear if that's now going to be a 2026 proposition or a 2027. And so, there are some uncertainties that I think are hanging a little bit over the big checks being written to really get going on all those fronts. But I'm totally in agreement. I think those two things are temporary impediments. And I think as we look beyond those, and hopefully we're all in sort of investing with medium term and long term time horizons, I think that's quite right. And so I've just finished. In fact, I just finished. I think it was an 11 city institutional client tour, and I shared that with my fellow economist Josh Nye, and we were presenting on the changing global order, which could not have been better timed. We proposed that back in October, and lots of Iran talk, but lots of talk about other things. And it's a more dangerous world. It's a power-based order. It's a multipolar world. All sorts of sort of swirling implications. Not all of them good. In fact, many of them negative. But one of the takeaways we kept flagging, particularly for Canada, is the world now cares more about resource security, and whether that's energy or food or other resources, it is a greater priority than it was, and Canada is very well positioned. And so we sort of looked from a Canadian perspective and said, well, it's still a tricky time to be a neighbor of the US, and it's a tricky time to be a medium power, not a great power, and so on. But when push comes to shove, Canadian exports are set to be in high demand, and you're sort of hopeful that a fortress North America concept does emerge. It was always the logical thing, and let's as the U.S. prioritizes the Western Hemisphere, hopefully we can get to a point where why would you tariff, and you should be leaning on Canada for those resources, and maybe Mexico for the cheap labor, and the U.S. leading the way on innovation perhaps, but others contributing as well. And so, yeah, I do think Canada has a lot of options there, and it seems like there's been an attitudinal shift at the policy level as well to help to make this kind of thing happen. So I think that's quite important. And boy, if we can get any kind of transparency on whether U.S. markets will be fully and enduringly open to Canada, hopefully in the next sort of 6 months plus, I would think we see a real surge of activity there. So that's what we're hoping, and indeed probably the best argument as to why Canada does look, as you say, pretty good over a longer period of time.
Yeah, and then hopefully we can do it on our terms
That's right.
as we've traditionally done it, to keep what is Canadian in the way that we do things, and which is a little different from our friends south of the border, and that's why we love Canada. But yeah, I just got a real feeling out being out west that that it is just that, hey, like we've got all this stuff, and maybe the world starts to look at us a little bit more, and so we've got more to export than Saskatchewan sealskin bindings, which of
Right,
course
Dave.
is
I was in Regina 3 or 4 weeks ago. We're just hitting Saskatchewan every which way. Isn't that something?
there we go. Well, I wish I'd seen you, but Super Dave has many places to go, and so do you, because you. I know you're up reading reports again and doing what Canada's hardest working economists would do. Eric, thanks for stopping in as you do every month. And again, we'll have to get you on in the middle of the month because I would like to dig into that changing world order presentation that you're
Yeah.
doing and see if we and have a discussion about that because that sounds really fascinating. You must be getting a huge response
Hmm.
in Saskatchewan and everywhere else you're going across Canada.
Exactly. That's great. Well, thanks for having me, Dave. It's always a pleasure. Nice to talk to everybody.
This podcast has been provided by RBC Global Asset Management, Inc., RBC GAM, and is for informational purposes as of the date noted only. It is not intended to provide legal, accounting, tax, investment, financial, or other advice, and such information should not be relied upon for providing such advice. RBC GAM takes reasonable steps to provide up-to-date, accurate, and reliable information and believes the information to be so when provided. You should consult with your advisor before taking any action based upon the information contained in this material. All opinions constitute our judgment and are subject to change without notice. The information presented here is provided in good faith without legal responsibility. RBC GAM reserves the right at any time and without notice to change, amend, or cease publication of the information.